At South by Southwest in March 2026, Professor Scott Galloway said something that wasn't supposed to be a thesis statement. He told the crowd, and I quote, "At some point, we have to stop propping up the markets with young people's credit cards." The audience skewed young. Nobody booed. They cheered. That moment accidentally captured the entire psychology of what Bloomberg has now named financial nihilism. The idea that the traditional rules of money, work hard, save consistently, invest in index funds, buy a house, retire at 65, no longer apply to a generation that can't afford the house, can't save because rent eats everything, doesn't trust that social security will exist for them, and watched the 2008 crisis, the 2020 crash, and every subsequent dip get bailed out before they had a chance to buy in cheap. In a world where AI can take your job, a global pandemic can disrupt your future. Home ownership is the most expensive it has ever been, and the return on investment in a college education is increasingly murky. Betting no longer seems like a risk. It seems like a necessary hedge against volatility. Today, I'm breaking down financial nihilism honestly. What's driving it? What the data actually shows. Whether it's irrational or whether it's the rational response to a system that structurally disadvantages young people. And I'm pairing this with one of the most important investing books ever written, A Random Walk Down Wall Street by Burton Malkiel, to ask whether his 50-year-old framework still applies to the generation that's quietly rejecting it. Welcome to Earnings Per Page. Honest finance, no hype. Hit subscribe. Let's get into it. First, what financial nihilism actually is. The term is Bloomberg's framing, but the behavior is real and data confirmed. 6 in 10 Gen Z self-directed investors say they are taking more risk than usual, according to research from Charles Stanley Direct. Nearly a third of Gen Z investors have been exposed to prediction markets, and the cohort leads all generations in meme coin activity and usage of speculative platforms like Polymarket. Among Gen Z and millennial millionaires, 50% hold crypto, compared with just 33% of their parents and grandparents. And roughly 44% of Gen Z and 49% of millennials say their decision to invest in crypto is influenced by fear of missing out. Social media ranked the top reason 55% of Gen Z and 44% of millennial investors say they got into investing. And critically, the rise of billionaire creators such as Mr. Beast is inspiring younger generations to try to build massive wealth by building big followings on social media. Nihilism isn't the right word for all of this. Some of it is rational. Some of it is dangerous. The honest answer requires separating the two. Lesson 1. Why the traditional playbook feels broken. To understand financial nihilism, you have to understand what Gen Z is looking at. The 2008 financial crisis wiped out a generation of would-be homebuyers, and the government bailed out the banks. The 2020 COVID crash saw the market drop 35% in weeks, and then recover completely within months, partially through unprecedented Federal Reserve intervention. The 2022 crypto and meme stock crash hit retail investors hard, while institutional investors had already reduced risk. In each case, Gen Z watched the system perform one way for established wealth and another way for people trying to enter. Every crash got backstop. Every dip was bought by institutions before retail could participate meaningfully at the bottom. Many younger investors don't believe traditional milestones will bring security, such as buying a home or staying at a job for a long time. This isn't irrational pessimism, it's data-driven skepticism. Homeownership requires a down payment that takes most Gen Z workers years to save, while rent consumes 40 to 60% of their income. Young investors often favor vibes and momentum over fundamentals, so they could get burned if this bull market stumbles. But the question is, can you blame them? Lesson 2. What Burton Malkiel actually said. A Random Walk Down Wall Street was first published in 1973 and has been updated regularly ever since. Malkiel's central thesis is one of the most important and most ignored ideas in all of personal finance. Stock prices follow a random walk, meaning that past price movements tell you nothing about future price movements. The practical conclusion is devastating for active traders. If prices are essentially random in the short term, then technical analysis, stock picking, market timing, and trading on momentum are all essentially gambling. They produce the illusion of skill while generating market, level, or sub-market returns on average. Malkiel's recommended alternative is spectacularly boring. Buy a low-cost index fund that tracks the entire market. Hold it for 30 to 40 years. Don't try to beat the market, because on average, even professional fund managers can't beat it after fees. He's been right for 50 years. The data consistently confirms it. Most active managers underperform the S&P 500 index over 10 years or more. Low-cost index funds are genuinely the most reliable path to long-term wealth accumulation for most investors. Lesson 3. The 50-year gap between Malkiel and 2026. Here's where I have to be honest about the limits of Malkiel's advice in the current environment. Malkiel's framework assumes you have money to invest. For a significant portion of Gen Z, there is no surplus. Rent, student loans, food, healthcare. These consume income before a single dollar reaches an investment account. Malkiel's framework assumes a 30 to 40-year horizon. That's only valuable if you believe the system you're investing in will be roughly intact in 30 to 40 years. If social security exists, if healthcare costs don't devour retirement savings, if climate risks don't disrupt property and financial markets in ways impossible to predict. Malkiel's framework assumes patience is emotionally sustainable. For someone watching their friends make 10 times their money on a meme coin in 3 months and simultaneously watching their rent increase by 20%, the emotional math of patient index fund investing is genuinely difficult. The argument isn't that Malkiel is wrong. His math is correct. The argument is that his framework was designed for people who had enough financial stability to invest in the first place, and for a significant portion of Gen Z, that baseline stability doesn't exist. Lesson 4. The rational core of financial nihilism. Here is what most coverage of financial nihilism gets wrong. It frames all of Gen Z's speculative behavior as recklessness driven by TikTok and FOMO. Some of it is. But what Scott Galloway described at SXSW is the rational engine underneath the behavior. If the traditional system is structurally designed to enrich those who already own assets, and if every crash is backstopped before young buyers can get in at the bottom, then the conventional playbook isn't just unappealing, it's genuinely less optimal for them than it was for previous generations. In Malkiel's time, a factory worker could save 10% of their income and retire with dignity. Today, a warehouse worker whose industry just shed 50,000 jobs may have nothing to save. In that context, a small speculative bet on a high-risk asset that could either pay off enormously or go to zero. Is that really more irrational than saving $50 a month for 40 years into a retirement fund you're not confident you'll reach? Lesson 5. The dangerous part of financial nihilism nobody talks about. Now, the honest counter-argument. The rational core of financial nihilism doesn't mean all of Gen Z's speculative behavior is smart. 3 specific dangers are real and data confirm. First, access to information can be empowering, but it also exposes young investors to misinformation and investment recommendations from influencers that may not have appropriate disclosures. Younger investors' susceptibility to FOMO is concerning because it can lead to reactive decisions influenced by hype without consideration of long-term goals. Second, leverage amplifies losses. When Gen Z investors trade options, margin accounts, or leveraged crypto products, they're not just taking risk. They're taking compounding risk that can wipe out principal faster than any market downturn. Third, the second that dip buying looks as if it didn't work out, this group could pull their money out of the stock market, making a minimal downturn far worse, considering that retail trading now accounts for a quarter of daily volume. The systemic risk is real. A generation of retail investors who entered markets based on momentum, not fundamentals, could amplify the next crash dramatically. Lesson 6. What actually works in 2026? Here's my honest synthesis of Malkiel's framework and the financial nihilism reality. For Gen Z with any surplus income, even small amounts, Malkiel's advice still works and is still the right foundation. Automate small investments into low-cost index funds. Time and compounding still function. Even $50 per month started at 22 will compound meaningfully by 52. For Gen Z with no surplus, the solution isn't better investment strategy, it's income. More earnings, better paying skills, side income, job transitions that increase earning power. No investment framework helps when there's nothing to invest. For Gen Z who want speculative exposure, Malkiel himself acknowledges that some speculative positions aren't inherently wrong. His advice is to limit them to a small percentage of total portfolio, 5 to 10%, and to treat them as entertainment, not as a retirement strategy. The thing he'd warn against most strongly is using leverage for speculation. That's where financial nihilism becomes genuinely dangerous. Final verdict. A Random Walk Down Wall Street is still one of the most important finance books ever written. Malkiel's core insight that beating the market consistently is nearly impossible, and that low-cost index funds beat most professional managers over time, is still correct in 2026. My rating, 9 out of 10. The advice is sound. The 2026 reality requires acknowledging what it can't fix. The financial nihilism trend is partly rational, partly dangerous, and entirely understandable given the structural economic pressures Gen Z is facing. The solution isn't to shame them for gambling, it's to build the income foundation that makes patient investing possible. And to be honest that for a generation priced out of housing, burdened with student debt, and facing AI-driven job disruption, the path to wealth looks genuinely different than it did for their parents. If this resonated, subscribe to Earnings Per Page. Next time I'm covering the US housing market's latest data and whether 2026 is finally the year buyers get a break or whether the crisis deepens. Drop a comment with whether you think financial nihilism is rational or reckless. See you in the next one.